Nobody understands Airbnb stock. The hedge funds don't get it. Retail obviously doesn't get it. They're fools. So today I have a suit, two microphones, and a shitty camera, I guess. So let's break it down. So Airbnb makes money in a couple of different ways. They do rentals, which are subdivided into short-term rentals. This is obviously their bread and butter. It's a $1.8 trillion total addressable market. And this is just your typical vacation rental. This anything less than a month. After that, we have long-term stays, and the difference is this one is 28 days or more and they get a discount. This is their fastest growing category by nights. A lot of digital nomads, a lot of people working from home, a lot of people taking months in Bahamas working for Google. We all know them. This is 20% of all their nights. Last but not least is experiences, and these are activities very typical to the city in which they're hosted. For example, in Egypt, you'll get a camel ride. In Miami, you'll get a boat party. In Paris, you might get somebody teaching you how to paint. But notice this product has not taken any development power since 2019 because of the pandemic. I believe this is one of the major opportunities with the platform. It's a $1.4 trillion total addressable market. So the takeaway from this is huge total addressable market. And if we want to make a lot of money, this is very important. Now, you got to understand that Airbnb is a very seasonal business, which means that they make a lot of money in summertime because a lot of people are traveling, but in wintertime, their revenue actually goes down. So the trend still goes up, but it's very difficult to actually account for this seasonality. So what we're going to do is a trailing 12-month revenue graph, and we're going to see this trend is actually very, very, very steep, and it's getting much, much steeper after Q1 of 2021. This is when people started going back to traveling, especially cross borders because of the pandemic. And we calculated the growth on a yearly basis, and 50.1% is very, very good growth. To give you an idea, Apple right now is growing about 15%. Google just posted a 6% revenue growth. Coca-Cola is doing 11%. There's only a handful of names that have this kind of market cap that are even approaching this level of growth. Now, will this revenue growth continue in perpetuity? It's impossible. But so far, it looks very, very good. But what about profitability? Because there's a lot of shitty ass tech companies that are growing very fast, but just can't make any money. So let's take a look at EPS. And notice there's a couple of things that I had to do to this one. Number one, I had to do a trailing 12 month as opposed to a straight up quarterly to adjust for the seasonality. But more important than this, I had to adjust for their IPO cost, because if you leave that cost in, that's about $3 billion. That's going to alter your trend. You won't be able to see. But look at this. There's just a big change in the business. It went from being very unprofitable to being very profitable. Look at this growth, this exceptional growth, especially for a tech company that is still not optimized for profitability. Yet they're printing this much money. How could this happen in such a short amount of time? That's what we like to call operating leverage. Look how the revenue is growing compared to their operating cost, which is just a fancy way to say the cost of running your business. Notice how revenue is just increasing at a much higher slope than their operating expenses. All of this distance is textbook operating leverage, and the more they grow their revenue, the more value they can capture into the business. Now I want to take a look at something that I don't see anybody talking about, and it's related to their cash in the balance sheet. The green graph is cash in hand. This means three things: cash and cash equivalents, marketable securities, and more important than that is the cash that they hold on behalf of their clients, meaning their host. Notice how the seasonality takes place, and this cash will actually come down in Q4 and then continue back up in Q1 and Q2 of next year. At the same time, as the rates are also peaking at 4, and a lot of people believe that rates are going to continue high as the Fed fights inflation. Obviously, they have all of this money that they own and all of this money that is not even their own money, and they could just put it in money market accounts, just earning yield. All of this is profit, pure profit. This is what Ron Barron calls float. And this is extremely powerful, and nobody's talking about this. In a couple of days, we're going to have Q3 earnings, and this will play a big role. But what about inflation? What about recession worries? What about the Fed? What about interest rates? What about all the macro worries that people are talking about. Luckily for us, we don't have to speculate on what the Twitter clowns are saying. We have visibility into Visa and American Express earnings reports and look at their commentary in terms of cross-border volume. According to Visa, their transaction volume cross-border increased 36% from last quarter. And if you exclude Europe, it's 49%. The reason for that is because Europe still had test mandates until very recently. And American Express just said that 57% from last year increase. And they mentioned that travel demand has exceeded their expectations throughout the year. And you might be wondering, even if the credit card companies are saying that travel is booming, there's no guarantee that travel will keep booming next year and the year after that, especially once this travel revenge season sort of gets over with, right? So I want to bring your attention to this video right here. Asta released 3 months ago their forecast for 2022 and 2023. And I want you to hear what these people are saying. Do remember, these people are some of the top travel agencies and travel agents. That's all they do for a living. They keep track of trends for travel because they don't do it, they go bankrupt, right?
But the phones are ringing, so it's a good sign. There is definitely interest there. Do I believe it will continue? Our 23 and 24 numbers look fabulous. Do I think eventually it will level off? I do. But I don't see that anytime in the near future. And I'll keep my fingers crossed.
You're seeing it as pent-up demand.
Absolutely.
Okay.
So pent-up demand is huge and we can see it continue into next year and more importantly, the year after that. This is not going to stop. People are going to continue to travel. After a pandemic, this trend is actually accelerating. Now let's take a look at competition because we have the hotel chains, Marriott and Hilton. And how come they're not taking Airbnb's lunch? Well, there's a couple of differences. So if we look at the gross margins, we see that one is not like the others. The cost structure for Hilton and Marriott is never going to be able to compete with Airbnb. It's never going to be able to reach the same level of profitability because Airbnb is extremely asset light and they have extreme pricing power in their services. So I would argue the hotel chains will never be as compelling investments as Airbnb because of their gross margins will never reach that kind of level. Airbnb has 80% gross margins. That is a software gross margin. A hotel chain will never reach software margins like that. Now for a more direct comparison, maybe we can take a look at Booking.com and Expedia. If we look at gross margins, Expedia is at the same level as Airbnb. Booking.com not so much. But what really separates Airbnb from the rest of the competition in terms of booking sites is revenue per employee. And this is a metric that has continued to increase along the years. Airbnb is just more efficient. They do more with less. They leverage their software expertise and they leverage their network effects in a way that Booking.com and Expedia will never be able to match. Look at Expedia's VRBO. Airbnb is just eating their lunch year after year. Now I want to bring your attention to a catalyst that every single investor is ignoring for some reason, even the top hedge funds. I don't see anybody talking about this. Not in Twitter, not in Seeking Alpha, not in stock tweets. How come everybody missed this? Airbnb is not even in the S&P 500. What are the things that Airbnb needs to be included? So number one, a market cap of 13.1 billion, check. The value of its market cap trade annually. It trades every 3 months, check. At least a quarter of shares traded in the previous 6 months. Well, they trade 5 million shares per day, so obviously check. Most of its shares in public hands, yes. Had its IPO in 2020, so yes. And have a positive sum of the previous 4 quarters in earnings, as well as the most recent quarter. We know that Q3 is going to be their best quarter ever, so obviously check. You know what this means? Money. And also notice that all their competitors are already at it in the S&P 500. The only one missing is Airbnb. But Airbnb couldn't be added before because they were not profitable on a 12-month basis. But now they're not only profitable, they're extremely profitable. So look forward to this being announced in the next couple months, maybe early next year. Of course, I'm not arguing for anybody buy or sell Airbnb. I'm just some dude on the internet. But that's all I have for today. This is just like my in-depth research, things that I found on Airbnb after a couple of months of research, to be honest. So if you found value in it, please consider subscribing and like the video. And until next time.